I think we've got a little bit frothy. That means we're kind of ripe for a little bit of a pullback, but it doesn't mean to say that the bull market is over, not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 6th through October 13th, 2025, while supplies last. First this week, 100-ounce silver Valcambi bars are just $2.79 over spot per ounce. Next, 1-ounce 2023 Mexican silver Libertad are $6.99 over spot per ounce. Finally, 1-ounce gold Valcambi bars are only $85 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, a retired Swiss wealth manager. Clive, thank you so much for joining us today.
Well, good evening, Elijah. I hope you're well, and I hope everything's fine. Which country are you in, by the way?
In the U.S., in Arizona, actually, but Yeah. How is it over there? Right here, it's October and it's still pretty hot. So,
okay. Well, we've got the cool weather. I mean, I don't think I'd like to be going out in a t-shirt today, but it's been a sunny day. So, realistically speaking, compared with many climates on the planet, it's quite lovely.
oh, fantastic. I did want to discuss what we're seeing in the gold market at the moment. It seems like things are definitely heating up there, and also in the silver market with silver racing towards $50 an ounce. And this really comes amid the government shutdown and concerns possibly of a recession and all of that. Your perspective and your analysis right now, what is happening?
Well, first of all, there was something which made me quite laugh this morning, and I won't name the bank, but it's a very major US bank, came out and said gold could reach $4,000 an ounce. And I looked at the price, it was $3,977. I thought, why do they wait until it's $23 away from the $4,000 mark to tell us it's going to reach $4,000? I mean, that's kind of an easy one. But I suppose they just want to say, we predicted it. Of course, you and I and many of your viewers have been saying that gold could go up to 4,000 and beyond. And we've been saying it for years. I think it's gone faster than many people expected, and the whole world, and I get many messages about from people saying this, when's the pullback coming? I'm not in, I want to get in, but is there going to be a pullback, and at what price should I put my limit? And I think the reality here is a lot of people missed the boat or feel they missed the boat, and so every time there's a pullback, they say, oh, it's happening at last, I'll get a lower price. And then that pullback starts to bounce and they say, oh, am I missing the boat? They'd rush in and then it gets pushed to another all-time high. So I think the problem we've got, it's not really a problem, it's just a feature, that gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of % off, if you're lucky, you get your order in when it's a couple of % off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars, it's euros, pounds, yens, whatever you like, maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And people are saying, well, we've got in Europe, we got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't know what's going to happen down the line.
It does seem like, as you mentioned, every time that we see precious metals pull back here, I mean, even today, we're seeing silver take a little bit of a dip. There have been clients calling me, really taking advantage of that. But your take on that, how it seems like there's just so much strength in the market right now. Do you sense at all it's getting frothy, or that we're nearing any sort of top, or is it just, you think, continued higher prices from here?
Well, I think we've got a little bit frothy, but that means we're kind of ripe for a little bit of a pullback. But it doesn't mean to say that the bull market is over. Not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio. About a week and a half ago, 2 weeks ago, I attended an investment conference at which many chief investment officers were speaking, from family offices and from some major banks. And I recollect in particular one of the major banks, it happens to be the one I bank with, was speaking, and he was saying, of course, with gold going higher, we've got it in our portfolio, we're recommending it to our clients, and we're using it in our discretionary portfolios. I thought, that's interesting, because my portfolio, discretionary, has got a 0% performance this year. I wonder if there's any gold in it. So I went to have a good look. And there wasn't an ounce of gold in my discretionary portfolio, despite the fact that CIO is standing on the stage telling everybody that they're smart because they put gold into the portfolios. So here's the reality. I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat NVIDIA, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60-20-20, with 20 in gold. Now, whether they're really putting 20 in the gold or that's just a sort of general comment, I don't know. I mean, it's not possible to put 20% in gold for every investment manager on the planet. There's enough gold out there at any price, so that won't happen. But if every investment manager could get to, say, an average of 2%, and I understand the figures are on average below 1% at the moment, that would push the gold price a long, long way.
It is crazy just how a little bit of movement into gold from investment managers it seems like could make a huge impact on the price. If it is, as you mentioned, below 1% right now, that would be a more than doubling if we just went to 2% of the investment managers, their holdings in gold.
Yeah, I mean, perhaps the below 1% number, I think, is a correct number. But to put it in context, a lot of the investments out there could not be in gold because they'll be, for example, an S&P 500 fund. It cannot be in gold. It'll be a fund dedicated to small caps. Can't be in gold because gold isn't an equity. So there's a lot of funds which just can't be in gold at all. So when I say below 1%, it's an accurate figure from what I understand, but it does encompass all kinds of investment vehicles which couldn't own gold under any circumstance, not allowed to, because it's not part of their mandate. So probably the real figure, which is actually invested where it's allowed to be invested in gold, is probably more like 2.5%. So I'd say for those mandates which can invest in gold, if they can get to 5%, we've got a large rise in the price coming.
Now, just in the last few days, weeks, we've seen the government shutdown, obviously, and you've been commenting on this, how there's really a fear of recession based on this, just based on how it's laying off so many, it's essentially leaving so many government workers out of work, and it also is potentially threatening a debt downgrade and other concerning developments as well. Can you expand on that, and why do you think? I guess, what do you think the ramifications of a government shutdown, if this does persist much longer, what do you think those could be?
Well, first of all, some parts of the government, including and non-government, including the Federal Reserve, rely on data for all kinds of things. So the Federal Reserve in particular is now flying blind. For example, we didn't get the non-farm payrolls report a couple of days ago because the Bureau of Labor Statistics has shut down. And there'll be a lot more numbers like the inflation numbers, the GDP numbers, all kinds of numbers we're not going to get. So the Federal Reserve is now going to have to make a best guess at what to do. But the whole world doesn't know what's happening. There's probably a whole bunch of numbers that different organizations around the world are relying on. They're not seeing it. And I just think that there's a certain nervousness that if you don't know what's going on, how do you know that your money, if you've got dollars, how do you know what your money is worth, if it's doing anything, and where you stand? So I think, again, it's once again another question of people saying, do I want to have it all in liquid cash, exposed to an environment where at the moment I may not know what's going on. I don't know how long this shutdown is going to last. I mean, people said it would be a couple of days. Well, we're a week into it now. And there's talk that there'll be some agreement done on the healthcare tonight, which might get it over. But from another point of view, if you've got 800,000 people, that's government workers, who are not turning up for work, mostly, and the question is not being paid. Now, the mantra is not being paid. I mean, my understanding, and I hope one of your viewers will correct me if I'm wrong, my understanding is when they go back to work, they will get paid, even for the period when they weren't working. But if, as some people are saying, they're not getting paid at all, in other words, they're losing 8 days' pay so far, well, that's a lot of money not going into the economy. A lot of people are going to be struggling to pay bills. And again, it will be another drag on an economy which is already slowing. And we know the economy is slowing because we've seen the job numbers. The job numbers have not been as strong as we've been led to believe by looking at the non-farm payrolls that we have seen, because we know that every month that number gets revised downwards to make the next number look that much better. And we've seen this very, very large writing back of the numbers. I think it was 800,000 or 900,000 jobs, which turned out never to have existed. So the way you could tell that wasn't real, and I said that a couple of times, was by looking at the household survey, because we had the household survey going in one direction and the non-farm payrolls going in the other direction. So one interpretation was that there were more and more jobs, and another interpretation was there's less and less people working. So which is it? I think it was the other way around. There was more and more people working, but less and less hours being worked. So the household survey I thought was the more reliable one, but the one that everybody hung on to was the non-farm payrolls, which is the establishment survey. But we now know, with hindsight, that those numbers were not what we were told. We now know they were much, much worse than expected. So we were consistently going towards an economic slowdown, less people working, unemployment was rising. And I think that does get worse now. I mean, artificial intelligence is not helping. We're seeing quite a few mass firings going on outside of government, I mean. And the reason that's happening is in many, many companies, in different departments, you'll have one or two guys who've wised up and got very smart with AI, and now they can do 3 people's work or 10 people's work. And these firms are starting to say, oh, you know what, let's get rid of 2% of our staff or 5% of our staff, and we'll get rid of the ones who are least productive. And the least productive ones are the ones who haven't mastered AI at the moment. So I think that's a slowdown. And of course, the other thing which is going on is big firms are not having much of a graduate intake this year, because whereas a year ago you got your graduate in, you say, go and write me a paper on this, that or the other. Now the boss doesn't have to say that anymore. It just says to AI, do it for me. And the AI has done it. So what do you need the graduate for? The AI will do it in a fraction of the time, and it'll be better quality. So slowdown, yes, we're going into a slowdown, I think. But what does that mean? It means that the Federal Reserve will most likely reduce interest rates, and as they reduce interest rates, that takes it puts the emphasis on employment rather than trying to control inflation, which means that the long end of the curve, the bonds which are longer dated, will tend to rise not rise. The yield will rise. The price will fall. The yield will tend to rise to reflect the higher inflationary expectations down the line. So at some point, and I think the market is starting to sense this, we'll get to a point where the interest rates have risen to an unacceptable level. And I don't know what that level would be, but perhaps it's 5 or 5.5%. To put that in perspective, we're around 4.1% now, so it's got a little bit to go. But we could see rising rates of interest at the longer end, at the 10-year or the 30-year end, which gets to a point where the Federal Reserve is invited to be buyer of the last resort. When I say invited, it might be more than an invitation. In other words, it might be an order. So the Federal Reserve, when it gets to the point where it starts to buy these government bonds, where does it get the money from? It electronically prints the money. So this is, when that happens, is the opposite of quantitative tightening. It becomes quantitative easing, and the balance sheet of the Federal Reserve will start to expand. So they print money, that's the liability side, and buy government bonds. That's the asset side. And the reason they buy government bonds is to stop the interest rate from rising, because the government can't sell those bonds to anybody else at that only just acceptable interest rate of, let's say, 5%. Let's say it's 5% is the acceptable, 5.2 is not, for example. So nobody's willing to buy the bonds at a rate of 5% except the Federal Reserve. So they basically put a cap on bond yields, hoping that on the one hand, by lowering the short-term rate, people will be squeezed in the longer run. But at some point, people say, my inflationary expectations for the longer run are actually quite high. They're higher, especially after taxes, than the interest rate I'm earning. I don't really want to own this bond at this price. I'd rather put my money into a house or gold or Bitcoin or commodities or silver, or, it doesn't really matter. But people are thinking, if I buy myself something now, it'll have more value in the future than I'll get by buying a bond and earning 5% and then paying tax on that. So I think the reason gold is rising, they're sensing that this rush of money will come, and we don't know when it's going to come, but I'm going to say could come, probably come in the next year sometime.
It seems like that's the trajectory right now, especially with the Fed lowering interest rates, at this last Fed meeting, and possibly lowering it twice more, lowering rates twice more this year. And if we do go into a recession, as you mentioned, those rate cuts could come, at a faster pace, and possibly even more quantitative easing, currency printing, all of that. As for the value of the dollar, it seems like often what we'll see gold anticipates inflation in the future, and we've seen gold doubling over the last couple of years. So it seems like gold is signaling that there's more high inflation to come. A lot of people, I think, were already hurt from this first wave of inflation. But if you look back at the 70s, we had kind of 3 different waves of inflation. And our good friend Tavi Costa has pointed this out, that there were 3 waves of inflation. And if that repeats itself, we may have just had the first wave, and the second wave could be much worse. What is your perspective on that?
Well, I think, first of all, inflation traditionally was demand pull. So you increase the money supply and you pull up the price of things people needed, like food. But we've moved into a world, at least for the time being, and I'm not going to say this will last, but at least for the time being, in the absence of any major wars or supply chain crisis, we've moved into a world where it's possible to expand the supply to meet increased demand. So even if we all have a lot more money and can then afford to eat twice as many pizzas, twice as many eggs, consume twice as many cows, the prices shouldn't rise too much, because with modern technology, they're able to expand the means of production to meet that extra demand. But what will be inflating, if you inflate the money supply, is when you and I get more money, we're not, realistically speaking, going to consume more of the daily goods. We're not going to watch more hours of Netflix or anything else. And even if we do, it doesn't really matter, because the supply is infinitely expandable. But what we might want to do with that extra money is buy us something which secures our retirement. And we know that the cost of things which are in short supply, like retirement homes, old age care, medical treatment, doctors, a nice country house by the sea, a holiday, a beautiful holiday on a cruise with your spouse and your family, helping your grandchildren to buy their homes. All of these things, the prices are going to be continuing to rise at a faster pace. And the reason they're rising at a faster pace is we can see that the amount of government debt is rising. At the moment, it's rising by about 6% a year, but it looks like it's going to go to 7% a year in terms of rising. And so what happens when the government increases its debt? The reason it increases the debt is because it's spending more than it earns in taxes. And this year it'll be about $2 trillion it will spend more than it's earned in taxes. So the debt will go, this year it's 37 trillion, it'll go to 39 trillion next year. And that's about 7%, 6 or 7% anyway, in that range. So as the government gets poorer because it's borrowing money and spending it, someone else out there is getting all that money. And whoever gets it in today's world doesn't say, I'll buy more bread. He says, I'll put it in the stock market, or I'll put it into gold, or I'll put it into houses, or I'll put it into a private equity investment, or I'll put it into something where I know that I can get a proper return on my money because I'm not getting properly remunerated at the rate of 4 or 5% on a government bond when they're increasing the supply of government bonds by 7% a year. Just doesn't make sense to earn 5 and that, there's going to be 7% more of them 10 years a year, every year. And that makes no sense. Why would anyone buy something, get remunerated at 5 when there's going to be 7% more because you've gone backwards by 2? That's before you paid your taxes. So that's, I think, the way people are starting to think. And therefore, money is cash in the bank where you're earning, 4% if you're lucky. It's looking for other homes.
It is looking for other homes, and that's, I guess, what we've seen. And people are concerned, I guess, really asset prices are increasing across the board, whether you look at precious metals, whether you look at the stock market, whether you look at cryptocurrencies. But a lot of people that we have on the channel, and I think you included, might say that things are about to change. It's not like everything is going to go up at once. What is your perspective on that? People holding stocks, holding these other assets, and who are not in precious metals, what kind of, or real estate, right? What kind of environment do you see going forward?
Well, historically, we've seen periods where one asset class is rising and another one standing still or going backwards. A very good example of that would be from the year 2000 through to 2010, where gold went up several 100% and stocks went down about 12 in that decade. So gold was doing the opposite of stocks. Then we have other decades where other things are doing well, whether it be property and I haven't got the periods, but I think everybody's seen this little square chart, which year by year it has the best and worst performing asset classes color coded, and you see every year it seems to change. One year it's bonds, one year it's equities, one year it's gold, next year it's silver, and it varies. But I think we're moving into a situation where you can't really say anymore that one is better than the other because they're all moving in tandem. All the asset classes are moving on the tangible asset classes or the things which are in short supply, because of course some things are not tangible. The things which are in short supply are moving upwards in tandem. And that's something which was described many decades ago, maybe it was 100 years ago, by von Mises. I think he called it the crack-up boom. And the way he described it, he says, to start with, prices are starting to rise, then the price of everything's starting to rise, and then you get to a situation where people start to say they want to protect their savings by owning those things that are rising in price. And then you get to the situation where people actually saying things are rising in price so fast, I don't want to own the currency, and it becomes harder and harder to change your currency into the things that people want to hold on to. So we're a long way from that sort of situation. We're not in a situation today at all where nobody will take your pounds or dollars. Everyone will take your pounds and dollars. But we are getting into a situation where there's a certain amount of those pounds and dollars which don't want to be in pounds and dollars anymore. They want to be in something a little bit more lasting.
Certainly, and that's what we've been seeing. I guess going forward here, last time we had you on, we were on a panel with Craig Hemke, and you had been talking a lot about gold revaluation. Do you have an update on that and your thoughts on whether in this environment gold could actually officially be revalued to any certain amount by the U.S. government?
Well, first of all, I'll say they cannot afford not to do it. So it's going to happen, in my opinion. The real question which is out there is, or three questions really. One is, will it happen? And I've answered that one. I think they cannot afford not to. The second question is, when will it happen? And the third question is, at what price? Now, there's been a lot of numbers bandied around about the right price, and I postulated that it might be $15,000, which I felt was the right level to, one, cover this year's deficit, a bit of next year's deficit, and pay off the maturing bonds in the next 12 months. So they could have a year or two of grace where the government debt actually goes backwards instead of forwards, because there'll be, as bonds mature, they'll be repaying them instead and not having to borrow. And as far as the current deficit is concerned, based on my $15,000 level, at least for a year and a bit, they would be able to pay all the bills without running, or all the excess bills above what they're collecting taxes, without running into deficit territory. So the debt of the government would be, for a year or so, maybe a year and a half, 2 years, be going backwards. And it would give a little bit of breathing space to work out what they'll do going forwards. Because obviously the debt cannot continue increasing ad infinitum, because, it can increase ad infinitum, provided it doesn't increase faster than the economy. But unfortunately, it's increasing much faster than the economy. The economy is growing by 1 or 2 or 3%, and the debt is increasing by 6 or 7%. So that can't continue. It's like you have a credit card. You might get a higher salary, but if your debt on your credit card is increasing by 10% a year, but your salary is only going up by 5% a year, you're actually going backwards. And in the end, you're effectively bankrupt, because you get to a point where the interest you're paying to the credit card company exceeds everything you earn. And that's the situation and the direction of travel that the government's in. And it's not just me saying it, it's the Bureau of Labour Statistics themselves who say the same thing. So 2 or 3 years ago, about 8% of government receipts went into paying the interest on the national debt. This year, it'll be 18%. So we go from 8 to 18% of the interest paying, of the tax collected going and paying debts. And the Bureau of Labour Statistics, if you read their official budget, which was brought out last January, so it's very, very old, and it's got worse since then. But when they brought out in January, they postulated that they predicted it. If you look at their own numbers and crunch them, you'll find that they're going to, in a couple of years, 22% of GDP. And that's based on an assumed interest rate that the government will be paying, which is significantly lower than the lowest rate they can get at the moment. Because the lowest rate the government can borrow at the moment is something like 4%. But the assumption is that interest rates are going to be knocking around 3% for all maturities. That's the Bureau of Labour. So they've underestimated the number. But even with that underestimated number, that debt is going to go to 22% in a couple of years of not the debt. The interest they're paying is going to go to 22% of what the government collects in taxes. Now, if you project that forward ad infinitum, you get to a point where the interest payments become a larger and larger share of the taxes being collected. The question is, at what point do investors say, I'm on a hiding to nothing. I'm not going to be repaid in anything which is worth something, because this is just spiraling out of control. If it was your best friend, you unless you wouldn't lend him money. You might give him the money because you feel nice to him, but you wouldn't believe that if he had a credit card debt of that size, that you've got any chance of ever being repaid. Now, people say, I will be repaid, because the government can effectively print money ad infinitum. They can tax the population ad infinitum if they have to. They could charge people, everyone, 100% of what they earn, and hopefully get it back. So people still believe that they're going to get it back from the government. But the reality is, if you do get it back, you're going to get it back in heavily devalued dollars 10 or 20 or 30 years from now, and it will not buy you the kind of things in retirement that you could buy with the same amount of money today. Is going to buy you an awful lot less. So I think it depends on where you are in life. If you're living hand to mouth, these things don't really affect you because it comes in one end and goes out the other end. And if prices go up, your salary will probably go up with it. But if you happen to be a wealth accumulator, you're now in a battle to say, what can I do to preserve my wealth? Because otherwise I will be going backwards, especially if I've got $1 million in government bonds or Apple bonds or anything else like that.
Yeah, I mean, I think that those are probably the people who are going to be most affected, and also like those on fixed incomes, right? Because, I mean, if you just look 10 years down the road, I mean, I was just reflecting on how there was so much demand for precious metals, right, in 2023 when everyone was calling us and saying they wanted to get their money out of the bank. And I was thinking, well, it didn't, materialize where, at least right now, everyone still has their bank deposits, right? It's not like, banks shut down and people weren't able to get their deposits, or the FDIC didn't insure those deposits and stuff like that. But in reality, ever since in the last 2 years, compared to precious metals, people's bank deposits have gone down by half. So those on fixed incomes or those holding government bonds paying 5%, it really is a reality check if you just think about, well, what is that income, or what are those bonds actually going to buy me in the future if in just 2 years, compared to real money, the dollar has been cut in half?
It depends what you're measuring it against, but if you're measuring against foreign currencies, of course, they're all falling together. So the pound, yen, euro, Swiss, even the Swiss franc, they're all, along with the dollar, they're all going down together. So when you look at the dollar versus a foreign currency, it may seem to have lost only, let's say, against the euro, only 11% this year, which is just a normal annual movement. Sometimes it goes up or down 11%. But if you think that both the dollar and the euro have probably lost 20 or 30% against gold this year, so they both are going down, and the whole world's watching dollar-euro balance, but they're not watching euro gold or dollar gold and saying, well, hang on a minute, in real money, if I own dollars, I don't have as much real money, being the gold, as I would have had a year ago by a long shot. And it doesn't matter which currency you look at. And that's not just new today. This has been going on ever since the world went off the gold standard. So that was in 1971 as far as the USA was concerned. The rest of the world had effectively come off the gold standard before that and gone on to what was since 1944 a dollar standard. So the US dollar was on a gold standard at a fixed rate of $35 an ounce. So the whole world, not Americans, but the whole world except Americans, were allowed to change their dollars into gold at $35 an ounce, or vice versa. And the US Treasury stood ready to deliver gold to any foreign nation who said, can we have our money back, please? And that all went on just fine and hunky-dory until the government the US government had continued to borrow more and more and more money, with the whole world believing they could turn it back into gold. And then some nations started to realize, well, they've borrowed more than they've got in the bank in gold, so they can't pay everybody. Let's try and be first. So country after country started asking for their gold back, which started to drain the USA of their gold reserves. So it got to a point where Nixon said for these speculators, these wicked speculators speculating against our currency, we've got to put a stop to it. So we'll temporarily close the gold window so that these wicked speculators, meaning foreign central banks who happen to hold a lot of dollars, couldn't change their dollars into gold anymore. And from that day on, the United States, it didn't happen immediately, but slowly, after a few years, they started to realize, well, it doesn't matter if we borrow more and more. It doesn't matter if we spend more and more, because nobody's going to come asking for their gold back, because they can't. They're not allowed to. So the gold price was floating freely. And of course, the more that the government got into debt, and it got into more and more debt year after year. Back then, the debt of the US government was in the billions. I don't know what it was. Now it's in the trillions, 1,000 times as much. But the more and more they got into debt, the more and more money was in the hands of other people. And as more and more money got in the hands of other people, some of them said, I'll put some of that in gold. Thank you very much. Of course, it benefited house prices, it benefited the stock market, and it benefited wages and salaries and everything else on the planet. Kept in a way, I'm not saying it's wrong, but it certainly kept the economy in a almost perpetual boom. I mean, since I started work in 1975, I guess I've only seen 4, 5, 6 large stock market declines or crashes, if you like. Maybe some of them crashes, some of them were declines in 50 years. That doesn't seem a lot to me. But every time there's a crash, well, you never, broadly speaking, you never had time to buy. So the best thing to do in a crash was do nothing, and the market would go down, then a year later it would be back up, and it'd be another all-time high. I mean, I've seen hundreds, possibly thousands of all-time highs. I've never yet seen an all-time low.
No, that's certainly a good point. If our viewers are interested in learning more and in continuing to follow your commentary, they can go to your LinkedIn page, which we'll put in the link in the description of this video. Do you have any last thoughts for our viewers? I guess those who are concerned about what is coming, what would be your suggestion to how they should be kind of thinking of this, the economy at the moment?
There will come a point, in all probability, and I don't know the number of years or minutes. We don't know. It could be very quick. It could take years. But there will come a point where there is some sort of crisis, and it won't be a crisis. It won't be one of the crises which are predicted. Almost every stock market crash or big decline has come from a reason which was not in the predictions. Every year, there's lots of predictions as to why things are going to go south here. War, recession, higher interest rates, falling dollar. Doesn't matter. There's always COVID. Doesn't matter. There's always a reason. But when that recession happens, when that crisis happens, it always comes from something that nobody saw coming. So there will be, and there always has been, at some point, a crisis, and we don't know what it's going to affect. But if it affects confidence in the currency, for example, it could be a very severe recession where the taxes are not being collected because people aren't working enough, and therefore they have to print a lot, and then the inflation gets out of control, or people perceive the monetary expansion gets out of control, and then they lose faith in the currency. Then emergency action is called for, and we don't know what that emergency action will be. I've got a pretty good idea what it'll be, but I do know from history, and throughout history, this has happened over and over again, where countries have become over-indebted, then they've faced a crisis, and then they've had to take some drastic action. In general, the next thing which happens is a new currency in some way, shape, or form. But there might be emergency actions as we go through, like confiscation, bail-ins, where they help themselves to the money in the bank. We just don't know. But if you want to get to the other side of it, you need to have some things that they can't take off you, or which are hard to take off you. Because if you have assets in the bank, especially if it's cash, it's like a sitting duck. If you have government bonds, they're in control, not you. You are owed money by somebody who can't pay. So what do you think? Do you think they'll pay you? In some way, shape, or form, you're not going to get what you thought you were going to get. Whereas if you happen to have something which they can't easily take off you, whether that be real estate or gold or something else that's in your physical possession, it could be bottles of whiskey, it doesn't really matter. And you might take the view they can't take my Nvidia shares off me. That's another view, because it's a lot harder to take someone's Nvidia shares than it is to take their bank account balance. But it doesn't matter. What I'm saying is, to get to the other side, you need to own things which they can't take off you. And some of those things should be in your personal physical possession, where only you can get your hands on them. And of course, given that you're a fan of gold, we know what that means for you. Can I just say that I did put out a video a couple of days ago about how to make a lot of money, almost like a free lunch, using a special technique and a special type of company which is quoted on the stock market. So anybody who wants to get into the stock market and wants to have a technique to make money, it's not guaranteed, not risk-free, but it's as near to risk-free as you can get. Have a look at my video. It's Clive Thompson on YouTube.
Fantastic. Thank you so much, Clive. You have a good day, and God bless.
Thank you very much, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 6th through October 13th, 2025, while supplies last. First this week, 100-ounce silver Valcambi bars are just $2.79 over spot per ounce. Next, 1 ounce 2023 Mexican Silver Libertad are $6.99 over spot per ounce. Finally, 1 ounce gold Valcambi bars are only $85 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.